All right, today we're jumping into one of the biggest and honestly most controversial topics in all of finance, stock buybacks. We're talking about companies spending trillions of dollars to repurchase their own shares. So the big question is this a genuinely smart way to reward investors? Or is it just a clever trick, a bit of financial sleight of hand to make the numbers look better than they really are?
And yeah, that really is the central question here. Are we looking at a sign of a super healthy, confident company? One that's just returning extra cash to its rightful owners? Or is it all just financial engineering, something that can hide some pretty serious problems and maybe even sacrifice long-term growth? Okay, so to really unpack all of this, we're going to break it down into 5 key parts. First, we'll get a handle on the sheer scale, and we're talking huge numbers. Then, we'll pull back the curtain on the simple math that makes these things so attractive. After that, we'll dive right into the heated debate. We'll compare the playbooks of a couple of corporate giants. And then finally, and this is the important part, we'll give you the exact questions you need to be asking. All right, let's kick things off with part 1, the scale of this whole thing. Because really, to get why this is such a hot-button issue, you first have to appreciate just how much money we're talking about. It's massive. Get this. In just one recent year, public companies spent over $1.2 trillion buying back their own stock. I mean, that is just a mind-boggling number. It often completely dwarfs what they pay out in good old-fashioned dividends. And look, when you have that much capital moving around, it doesn't just stay on Wall Street. It impacts everyone, from you and me as investors all the way to the broader economy. And that's exactly why we need to understand what's going on.
Okay, so how does this whole thing actually work? What's the mechanism? Because to really get a grip on the controversy, you have to understand the simple, almost magical math that's going on behind the scenes. This is where you can see it as either genius or, manipulation.
It all boils down to one of the most famous metrics in finance, earnings per share, or EPS for short. The formula is super simple, right? You just take the company's total profit, the net income, and divide it by the number of shares that exist out in the wild. This little number is one of the most watched metrics out there, and as we're about to see, it's the main target for a stock buyback.
Okay, let's put some real numbers to this so you can see the effect. It's actually pretty wild. So before the buyback, our pretend company here makes $1 million in profit. There are 100,000 shares out there. Simple division, right? That gives us an earnings per share of $10. Now watch this. The company takes some of its cash and buys back 20,000 of its own shares. The key thing here is the profit is exactly the same. They didn't sell one more widget, still $1 million. But now, that same $1 million profit is divided by only 80,000 shares, and poof, the EPS jumps to $12.50. The company didn't actually become more profitable, but on paper, on this key metric, it looks 25% better. That, right there, is what they call the arithmetic lift.
So that simple bit of math we just walked through, that's the engine behind this entire debate. And now that we get the how, we can dig into the why and the should they. When is this a legitimate, smart financial tool, and when is it a deceptive trick that comes with some really serious trade-offs? So let's say you're a company, and you're swimming in extra cash. The classic choice is, do we give it back to shareholders through a dividend, or do we do a buyback? Now, from the CFO's perspective, buybacks have some pretty compelling perks. For one, they're super flexible. You can start them, stop them, dial them up or down. It's easy. Dividends, on the other hand, once you start paying them, the market sees it as a promise. Cutting a dividend is a huge red flag. Plus, for many investors, buybacks can be more tax efficient. So you've got flexibility and tax benefits. It's no wonder they're so popular in the boardroom. Okay, but here's where things get really murky. This creates a huge, and I mean huge, potential conflict of interest. Remember that arithmetic lift that makes EPS jump? Well, it doesn't just make the stock look good to Wall Street. It can directly line the pockets of the top executives. When you see that nearly a third of CEO pay is tied to metrics like EPS, well, you can see the temptation, right? There's this massive incentive to use company cash to pump up that EPS number and trigger a fat bonus, even if investing that cash back into the business would have been better for the company in the long run.
And this brings us to one of the sneakier uses of buybacks, and one of the biggest criticisms you'll hear. See, some companies aren't really using buybacks to shrink the pie and give shareholders a bigger slice. Nope, they're just using them to cancel out or sterilize the millions of new shares they're constantly handing out to employees and executives as part of their compensation. The difference can be just wow. Look at this. Over a decade, Apple really did shrink its share count by a whopping 35%. Now look at Meta. A staggering 82% of all their buyback spending just went to soak up new stock grants. The actual number of shares barely budged. So in a case like that, is it really a return of capital to shareholders? Or is it more like a giant hidden cost of employee compensation?
And this is where the trade-offs can become absolutely devastating. We're talking about a massive opportunity cost. The story of Intel in the 2010s is a really chilling case study of this. Think about it. At the exact moment the world was going mobile, a revolution that demanded billions and billions in new R&D to create the next generation of chips, what did Intel do? They spent more than 100% of their profits, let me say that again, more than all of their profits, on buybacks and dividends. They essentially chose to please Wall Street in the short term instead of investing in their own future. And we all know what happened next. They fell behind, lost their technological edge, and even lost Apple as a customer. A brutal lesson.
But, and this is a really important but, this does not mean all buybacks are bad. Not at all. The philosophy behind the buyback, the discipline, that's what separates the good from the bad. So let's look at two corporate giants that have completely different but equally disciplined strategies.
So on one side, you have Apple. You can almost think of them as a high-efficiency ATM for shareholders. They generate an absolutely colossal amount of cash, and their goal is to return any excess cash back to investors. They've returned over $500 billion this way, shrinking their share count dramatically, all while still spending record amounts on R&D. Then, on the other side, you have Warren Buffett's Berkshire Hathaway. They are the ultimate value disciplinarians. Their rule is simple. We will only, and I mean only, buy back our stock when we believe it's selling for less than it's actually worth. The second the price gets too high, they just stop. They turn off the spigot and save their cash for a better opportunity. Two different playbooks, but see the common thread? It's discipline. It's not about juicing a quarterly number. It's about a clear, long-term capital allocation strategy.
Okay, so this all leads us to the final and maybe most important part. What do you do with all this information? What are the practical, smart questions you should be asking whenever you hear a company is launching a big buyback program? It really comes down to a simple 4-question toolkit. Ask these and you'll be way ahead of the game. First, where's the money coming from? Is this from genuine excess free cash flow, or is the company taking on a bunch of debt to finance this, which is way riskier? Second, what's happening to the actual share count? Is it really going down over time, or are they just running on a treadmill, buying back shares just to offset all the new stock they're issuing to insiders? Third, what's the price? Are they being disciplined like Buffett, buying back stock when it's on sale, or are they just throwing money at it when the stock is hitting all-time highs? And finally, number 4, the opportunity cost. Is this buyback happening while their R&D budget is getting slashed? Are they falling behind competitors? Are they pulling an Intel? So the next time you're reading the news and you see a headline about some company's massive new stock buyback plan, you'll be armed. You'll know what to look for. You can ask yourself, is this a true signal of confidence and strength? Is this a disciplined company that's so successful it literally has more cash than it knows what to do with? Or is it just a mirage? A bit of financial wizardry designed to make things look better than they are, maybe at the expense of the future? Honestly, the answer to that question tells you pretty much everything you need to know.